Hello and welcome to part one of BFSG's 3-week financial literacy series, Money Mastery. I'm all about building a strong financial foundation. Today we'll be discussing how to save and build good credit. A few housekeeping items before we begin today. There's a Q&A box in the Zoom menu for all of you logged on the computer, which is distinct from the chat box. As you have questions come up throughout, there are approximately 30-minute presentation today. Please feel free to type all of your questions into the Q&A box, and we will answer all questions at the end of our discussion. Due to compliance reasons, being on a live and recorded webinar, we will not be unmuting lines. So please type in all questions into that distinct Q&A box. Should your questions be more personal in nature, we will provide contact information at the very end of the webinar today and encourage you to reach out directly rather than asking personal questions on a live and recorded webinar. The same registration link will also be active following the webinar for a full on-demand replay in case you would like to listen again and or share with friends and colleagues. Lastly, we will also have a post-webinar survey, which will only take about 1 to 2 minutes to complete. Please provide your feedback so we can kind of streamline some future sessions. Most of this being the feedback from our summer webinar series. We're always looking for new ideas to make sure we keep everybody informed with content that you appreciate. With that in mind, let me pass it over to our panelists for introductions. Paul.
Unmute is good, I'm learning. My name is Paul Horn, Senior Financial Planner with Benefit Financial Services Group. Thank you so much for joining us today, everyone. I'm part of our wealth management team here in Irvine. Along with me presenting will be Arash Nabi. Arash, can you tell us a little bit more about yourself?
Thank you, Paul. Hi, everyone. Thank you for joining us. My name is Arash. I'm one of the financial planners here at BFSG. I'm also the company's controller, so my background is in accounting. I'm a CPA and a certified financial planner. I'm excited to be here talking to you about budgeting and personal finances.
Thank you so much. And then finally, we have Chad Nurani on the call. He will be our moderator for today's call, handling our interactive polls and leading the question and answer portion at the end of the call. Chad, go and take it away with our first poll.
Yeah, thanks, Paul. So our first poll today, this is interactive. I will launch it in just a couple moments. We have, I think 3 of them today. Icon will pop up on your screen so that you can vote. The first one on managing finances. How would you describe your ability to manage your finances today? Just a way for us to kind of gauge the audience as we kick off our presentation today. I've launched polling now. I'll leave it up for about 15 to 20 seconds. Okay, and with most people that have responded, I'm going to close polling now. And let me share results today. We have a few people that say they have to pray each time they do a transaction. A few people say they're experts. And the bulk of people say that they do okay. I'm assuming that hopefully we can share some insightful information on today's call.
Thanks so much, Chad. Arash, can you tell us a little bit more about why it's important to learn about finances?
Sure. So you may be asking yourself, why do I need to learn about finances? Well, financial transactions are part of our daily lives. Nowadays, we have many transactions throughout the day, and with the subscription payments, online payments, it's easy to lose track of our expenses. So it's important to have a basic understanding of our finances. But unfortunately, our education system failed in teaching us about personal finances. And that's why we hear often that over 70% of people are living paycheck to paycheck. It's because they never got that proper education. Our goal today is to go over the basics with you. We're going to talk about budgeting, savings, emergency funds, and what credit score is all about. We hope that this will help you have a better understanding of your financial situation and make better habits when it comes to money.
Thank you so much. So for the first part we're going to talk about is budgeting and saving, guys. And I know this may seem a little bit boring, but this is really the cornerstone of someone's financial success. If you don't have a budget and you're not saving, you're not going to be able to do things like build wealth and have a comfortable retirement. I love this quote here by Warren Buffett. Do not save what is left after spending. Instead, spend what is left after saving. Simply put, pay yourself first. If you're not going to pay yourself first, no one else is going to. So when I say pay yourself first, what does that mean? Well, when your paycheck hits your bank account, because I assume most of us have direct deposit these days, what we want to do is set up some form of automatic transfer into a savings account or into an investment account so that money is automatically being saved for you. This keeps things very simple. This allows you to live off the rest of the money and you can spend that freely. Chad, go and take it away with our second poll.
Yep, thanks, Paul. So next poll is, which of these scenarios fits you best? So if you were to find a $5 bill on the street, what is the best option for you? Or you saved $5 on a $50 pair of shoes, or maybe you used $5 coupon on a $1,000 flat screen TV, or are all of these three scenarios exactly the same? And so with most responses in, let me end polling again. I will once again share results. And again, what you can see with here, we have, a bulk of people actually say that the best option is to find $5 on the street. A lot of other people, about 30%, say they're all the same. With that, let me stop sharing and I'll give it back to our moderators.
Thank you so much, guys. I know for me personally, I would feel the best if I found $5 on the street because that's free money. But in reality, these really are all the same. At the end of the day, each of those options is going to give you an extra $5.
All right, so one of the first steps in understanding our finances is getting to know our earnings and our paycheck. I know for some of us, when we first got our paycheck, it can be confusing because there's so many line items, so many deductions. So we're going to simplify this for you by going over a sample paycheck, and we're going to break this down into two steps. First, we're going to look at the earnings, and then we're going to look at the deductions. So the earnings part is actually pretty straightforward. In this example, the employee worked for 50 hours at a rate of $10 per hour, and they made $500 in this pay period. And the column on the very right-hand side just shows all the amounts year to date. So YTD stands for year to date. So that basically covers the earnings. And below earnings, we have the deductions. So deductions usually fall into two categories. We have the required deductions, and we have the other deductions. The required mandatory deductions is where you see your tax withholdings. Here we have the federal and state taxes. These are taxes that pay for schools, roads, the military, and other services that the government provides us. Over here, we also have the Social Security and Medicare taxes. These taxes help fund government programs that pay for retirees' retirement needs and medical care needs. So those are all the required deductions. Then we have the other deductions, and that really depends on your employer. In some cases, you may be contributing to your health insurance premiums, and you'll see your deductions over here in your paycheck. And also, if your employer has a retirement account set up for you, like a 401k account, you'll see your 401k contributions here. If you do have a 401k account with your employer, we highly recommend that you contribute to it, because in most cases, employers match a portion of your contribution, which means you'll get more money from your employer by just contributing to your retirement account. Below the deductions, we have the net pay. So net pay is basically your gross pay minus all the deductions. And this is the amount you take home to pay for your expenses and your bills. And this is also the amount we will use to create your budget in future slides when we discuss budgeting.
One of the most common questions I get is, well, how do I save? One of the things that I would recommend using is what I call a 3-bucket approach. This is simply just dividing your money based on time horizon. So the first bucket is that short-term bucket. This is for any goal that's 2 years or less. We then have our midterm bucket, which is 3 years or more. And finally, the retirement bucket, which for most of us will be the largest bucket. One good rule of thumb that I'd recommend if you're trying to figure out how much to save is using what I call the 10-10-80 approach. So as Arash just mentioned, that you get that net pay at the end of the paycheck and that hits your bank account, we want to set up those automatic transfers that we talked about. You want to try and save 10% into the short-term bucket. You want to try and save 10% into the retirement bucket, trying to live off about 80% of the money that you bring home. We'll talk more about that midterm bucket in just a second. So first, focusing on that short-term bucket. What is this? It's simply put, your emergency savings. This is the money that you want to keep under a pillow, in a savings account or a money market. You want to keep this someplace very safe for when life happens. This year is a great example. I'm sure you or someone you know has probably been impacted financially by COVID. Just a great reminder as to why we want to keep 3 to 6 months worth of living expenses on hand at all times to handle those what ifs in life. This way you're not having to take on debt or things like that to help pay your bills. The second bucket is what I call your wealth accumulation bucket. This is really going to be used for your non-retirement goals. At some point, you're probably going to want to get married, start a business, buy a home, maybe go to grad school. This bucket is to help designed to meet those sort of goals. Okay. This bucket, because we have a longer term time horizon, typically 3 years or more, we want to use some form of taxable investment account. So this could be a brokerage account at Fidelity or Schwab, for example. This is going to give your money better potential growth over the long term. And then finally, that third bucket is your retirement bucket. For most of us, this is simply just going to be our employer-sponsored retirement plan. So that would be either a 401k, 403b, or a 457 plan. With these plans, oftentimes employers nowadays offer some sort of match. As Arash already mentioned, just please make sure that you're at least taking advantage of the match, if nothing else. So for example, if your company says that they will match 5% of your contributions, make sure you're putting in at least 5%. Because that's free money. I don't know about you, but I like free money. With these plans too, there's typically options that you have. So specifically, you can either contribute into a traditional account or a Roth account. For most of you on today's call, if you're wondering which account to contribute to, the answer is going to be Roth. Let me ask you this question. Would you rather have $1 million taxable or tax-free in retirement? If you're like me, I assume you're going to choose tax-free. That's the Roth account. The money goes in after tax and that money grows tax-free, and that provides a nice tax-free nest egg in retirement. The traditional IRA gives you tax deduction now, but unfortunately you have to pay taxes on all that money when you start withdrawing it during retirement.
All right, so let's talk about personal financial statements. I'm sure many of you have heard the term financial statements. Businesses use financial statements to help them organize their financial information to have a better understanding of their operations. So just like a business, individuals should have their own financial statements to have a better understanding of their financial situation. So here we're going to talk about two statements. First, we're going to talk about your income and expenses and help you create your budget. Then we're going to talk about your net worth statement. So for the first one, you want to write down a list of your income information. That would be your net pay, any money, the net pay from your employer, any money you get from side jobs or any other sources that you have. You want to list them on a piece of paper on an Excel file. And then below it, you want to list all your expenses. That would be your mortgage, your rent payments, your car payments, your utility bills, groceries, or any other expenses that you have throughout the month. Once you have all your expenses listed, you want to subtract that total from your income and you see how much cash you have left over. So if you have cash left over and that amount is positive, that's great. Now you know if you can contribute more to your retirement accounts, or you can decide to put some money to those buckets that Paul just discussed and increase your savings and investments. But in some cases, that amount could be negative because you're spending more than you're making. That will happen if you're spending money on credit cards. So it's a good opportunity to look at your expenses to see where you can cut costs and lower your expenses. I know this might take an hour or so to put together, but the good thing about it is that this will help you create your budget. This is basically your budget. So you want to go over your expenses line by line and look at them carefully and see if you can put limits for yourself and hold yourself accountable. And perhaps if you can see if you can eliminate some of those expenses that are unnecessary and increase your savings. So that's basically your budget. And the next statement is your net worth statement. And net worth is basically assets minus liabilities. Assets are things like the current value of your house, current value of your car, current value of your bank accounts, your retirement accounts, and any other personal valuable item that you may have. And liabilities are current value of your mortgage, current value of your car loans, your student loans, your credit card balances, or any other loans that you have. Once you have all that information, you want to subtract the liabilities from your assets and see your net worth. So that's how much you're financially worth at this point in time. For some of us, or some people who just graduated from college and they're just starting off, they may have big student loans and may have car loans. So that net worth could be negative, but I wouldn't worry too much about it because that's just normal. And over time, you're gonna start saving, increasing your assets and paying down your liabilities, and your net worth will turn positive. Just want to point out that you should regularly monitor these two statements and update them as your situation changes, and make sure it's accurate to help you increase your savings and investments.
Thanks
Hey
so
guys,
much.
one additional note on this page, guys, before we move on is I know we have on the bottom right a label of good or bad, with the idea that in general, positive income and lower expenses are good and bad. Positive assets and lower liabilities tend to be good and bad. Things like credit card debt, not very good. But the reality of that is there could be some debt that is actually good. So think like a mortgage, if you're building equity in your home, is actually a good liability. So don't get confused with that good, bad. Those are really meant to be general rule of thumb terms.
Yeah, and if this is your first time putting together a budget or something that you struggle with doing, there's some great tools out there. Number one, with your bank probably offers some sort of software that can be used to help track your spending easily. If you do most of your expenses on a credit card, most credit card companies will offer the same tool. If you're not sure where to start or don't know how to use that, you can also contact us. We'll provide the information at the end of the slide here, and we can provide you guys a free template to use as well. All right, Chad, go ahead and take it away with our third poll, please.
Yep, thanks, Paul. So our third poll, this is just a fun poll now, just to gauge the audience and what you all think is the correct answer out there. But approximately what percentage of people say that debt is ruining their quality of life? The answers are 20%, 30%, 40%, 50%, and almost everyone. I've just launched polling. I'll leave that for 15 to 20 seconds. Okay, with most people having voted, let me end polling and I will share the results with the group. And almost 50% say almost everyone. That's the camp that I'm in. Debt is definitely a big burden. About a quarter of the people out there say 50% say that debt is ruining their quality of life, and about 16% say 40% of the population says debt is ruining their life. Let me give it back to Paul for the actual results.
Thank you so much. Well, I'm glad to say here, based on that survey that was done, only about 30% of people say that their level of debt is ruining their quality of life. However, in that same survey, 56% of those people say that they're worried about getting out of debt. And in that same survey, 32% of people say that getting out of debt is their biggest financial priority.
So why is good credit so important? Well, our credit score determines how much interest we pay. So every time we borrow money from the bank or buy things on credit, those businesses and banks keep track record of our payments and share with credit agencies who form our credit score. So if you have a good credit score because we're paying our bills on time, they'll charge us less in interest. If we haven't been paying our bills on time, we have a bad credit score, they'll charge us more in interest. So it's very important to maintain a good credit score and monitor it closely, because it could have big impacts in our lives. For example, it could determine where we live. Let's say you want to get a house and you have to get a mortgage. If you have a good credit score, they'll charge you less in interest, which means you can get a bigger mortgage and a nicer house at a better location. So it's important to monitor your credit score closely. And we have an example here that we're going to share with you to demonstrate the impact of credit score on our interest rates. So let's say you want to purchase a car for $15,000 and you want to borrow that money and pay it back in 5 years. If you have a credit score of 500, which is considered poor credit score, your interest rate per year would be 16.5% and your monthly payment would be $368. But if you had a good credit score, which is something like 720, your interest rate would only be 3.5%. Your monthly payments would be around $272. That's a savings of $95 per month, which means over the course of 5 years, you'll save about $5,700. That's basically over $1,000 in saving every year. And that's more money that would you have to pay down your debt, increase your savings, or for some of us that like to travel, you can use it for traveling. So just by having a good credit score, you can really save a lot of money.
Thank you so much. So let's talk about what factors determine your credit score. So looking at all the different things that impact your credit score, the single largest, over 35% of that, is simply your payment history. Are you paying your bills on time? We know life happens, and occasionally you maybe have a late payment. That's fine. Just try and avoid 30, 60, or 90 days late. Each time you're hit one of those marks, 30 days, 60 days, or 90 days, that's another ding on your credit score. So for example, let's say you have a credit card that's 4 months late, you're gonna have 3 separate dings on your credit score, lowering your credit score as a result. The next biggest thing that they look at is credit utilization. This is almost 1/3 of your credit score. Credit utilization is looking at what percent of the total credit, available credit are you using. So for example, let's say you have a credit card limit of $10,000. You want to keep the credit card balance under $2,500. That would be a credit utilization rate of about 25%. If you get above this threshold, that's going to begin to lower your credit score, and your credit score is going to go lower the closer you get to maxing out your credit cards. Then they look at credit linked history is 15% of your total credit score. So some of you may have older credit cards on hand that are just sitting around. It's typically a good idea to keep them, maybe just put them in a safe or lockbox somewhere that you're not going to be tempted to use them, because over time that's just going to help you build your score. And then the last 2 items of 10% each is your credit mix and new credit. So every time that you have someone run your credit, what happens is they create what's called a hard inquiry. And that hard inquiry is going to stay on your credit report for 2 years. The more times that you have ran your credit, that's actually going to potentially lower your credit score as well. So let's talk about paying off debt. When we look at paying off debt, there's one of 2 strategies to use. If you're someone that has a lot of debt, maybe you have 3 credit cards, a student loan, and an auto loan. If that's the case, an easy method to use is what I call the snowball method. The goal here is to pay the minimums on all your credit cards, all your debt, except for the debt that has the smallest balance. So whatever extra payment you can make each month, you apply that to the smallest balance. With this method, the goal is to pay off the smallest balance first. Once that's paid off, let's say you're paying $400 a month there, you continue to pay the minimums on all the smaller debts, and you just apply the payment that you're making here to the next smallest debt. And you continue to do that until you've paid off the largest balance. The benefit here is number 1, simplicity. If you're paying a lot of different bills each month, paying off some of those bills is a good thing. It's going to make it a little easier to make sure that you're paying your bills on time. Secondly, it's going to help you stay motivated. When you pay off that first debt, it's going to feel really good. It's going to put wind in your sails. It'll help keep you motivated and make it easier to pay off the bigger debt. The alternative method is using what's called the Avalanche method. And this one doesn't focus on the balance. This instead focuses on interest rates. The idea here is, again, you pay the minimum on all your credit cards or all your debt except for the one with the highest interest rate. Whatever debt that is, you apply all the extra payments you can make each month to that specific debt. When that debt is paid off, again, you just apply that same payment to the next highest interest rate debt, next highest interest rate debt until they're all paid off. The advantage to this method is you'll pay off your debt faster because you're going to save money on interest over time.
Great. These 2 are great strategies, Paul. In my experience working with clients, if you need that extra motivation, that snowball method will really help you knock out those credit cards. I just want to make one point in regards to this. If you do have credit card debt, please include those payments in your budget and use your budget to your advantage to help you pay off your credit cards, because the budget will really help you monitor your expenses closely. So here's a list of types of credit that now we have available to us. We have credit cards, auto loans, student loans, installment loans, home mortgage, and home equity lines of credit. Most of these are pretty straightforward, but I'll give you an example for the installment loans. That would be like you go to Best Buy and you want to buy a TV or an appliance, and they allow you to pay for it over a 24-month period. And nowadays, most vendors and stores let you pay for everything on installment loans. And also home equity line of credit is just another type of loan that banks offer you if you have a house and you have a mortgage and you have built up equity in that house.
Thank you so much. Chad, can you go and take it away with our final poll for today?
Yep, thank you, Paul. So this is going back to the credit cards before we move on. Just how long would it take to pay down a credit card? So approximately how many years will it take to pay off a $10,000 credit card, making just the minimum payment, assuming the interest rate was 20%? Got 10, 20, 30, 40, and it will never be paid off. Let me launch polling right now. I'll leave it up again for about 15 to 20 seconds. And with most people having responded, let me close polling. And again, I will share the results. And again, we have almost 40% saying it will never be paid off. And then a good split between 15 and about 20 at that 20, 30, and 40 years. Let me stop sharing results and I'll hand it back to our panelists to share the actual numbers.
Thank you so much. Most of you guys are pretty correct here. If you're paying on a credit card payment, sorry, if you're paying the minimum payment of about $200 a month on a $10,000 credit card with a 20% interest rate, it's going to take you 30 years to pay that off. In fact, over the time period, your total payments will be greater than $45,000. This is why we want to try and avoid paying the minimums as much as we can, and we really want to try and avoid carrying any sort of credit card balance for a long period of time. If you have credit cards, please pay them down as fast as you can. As you can see here, that minimum payment has very little help to you, but a huge help to the bank. Paying on a $10,000 debt, paying more than 4 times over the life of that debt is pretty crazy.
So we have some tips to building good credit for you guys here, and we hope that you guys can implement this in your daily lives and take advantage of them. First one is pay your bills on time. I highly recommend that you set aside a day in the week to pay your bills. For example, I pay my bills on Sunday. It gives me time to go over them carefully and compare them to budget, make sure I'm not overspending, and also builds that habit so you're on a schedule, so you ensure that you're paying your bills on time. Number 2 is pay off debt and keep balances low. So if you're buying things on credit cards, you want to make sure you pay off that credit card at the end of the month, or at the very minimum, keep the balances low so you're not getting hit with those interest payments.
Yeah, one thing I would recommend here, as you guys are paying off that debt using one of those 2 methods we talked about, either the Avalanche or Snowball, if you have credit cards in your wallet, take them out once they're paid off or paid down. Don't leave them in there because they're probably going to literally burn a hole through your wallet and you'll be tempted to spend them. Instead, take them out like we said before, put them in a lockbox, put them in a safe. If you don't have one of those, a trick I've had some clients to do, and this is for real, is you take your credit cards, you put them in a glass of water, you take that glass of water and put it in the freezer, literally putting your credit cards on ice. If you need your credit cards for any reason, if life happens and you need access to them, they're there for you. They will be fine. But if you're tempted to use them for purchasing something that is a want versus a need, as you're defrosting them, you're going to realize how silly it looks, and it's going to help keep you from spending the money on using your credit cards for things you probably shouldn't be using it for.
Yes, and number 3 is apply for open new credit accounts only when you need them. So credit cards are useful nowadays. It helps us build our credit. It also makes transactions more secure and easy online. But again, if you don't need it, don't open it, because if you already have 2 or 3 credit cards, that's really all you need. And by opening it, like Paul just said, it just tempts you to spend more money. So if you don't need it, don't open new accounts.
Yeah, and in general, always avoid the store credit card. So if you're at Best Buy or Nordstrom or wherever it is and they offer you the credit card for the big discount on today's purchase, always say no.
Number 4 here, don't close unused credit cards. So many of us have credit cards that we got a long time ago, but we don't use them anymore because we have a credit card now that has better points and more advantages. So we don't use the old ones. But you want to keep those old credit cards aside in a safe place, because by closing them, that'll impact your credit score. As Paul mentioned earlier, it may impact your utilization score. So it's best just to keep them somewhere safe and leave them open.
Yeah. And
go ahead, Paul.
one thing I want to add there too, if your credit card has some sort of annual fee, Some older American Express or Visa cards, for example, may try and charge you like $250 a year just to have the credit card. Contact the company. You can typically get that fee waived. If you can't, then that may be a reason to look at potentially closing a credit card if you're going to be paying a bunch of credit card fees instead of interest. And then the fifth one here is don't apply for too much new credit. As we talked about, if your credit's ran too many times, that's going to impact your overall credit score. And so only apply for credit when you really need it and plan on using it, just to help protect your score overall.
Exactly. And the last two really go hand in hand. Regularly monitor your credit score and dispute any inaccuracies on your credit reports. So this is actually easy to accomplish nowadays. Most banks like Chase, Wells Fargo, Bank of America, they have a section on their website or on their app where you can see your FICO score. So if there's any unusual activity in your accounts, that'll impact your score, and you can look into it and investigate it and see what's causing that. And also, the three main credit agencies together operate a website called annualcreditreports.com, where you can go and request a free credit report from each of them once a year. And this is actually very easy to do. Last week I did it myself. You just enter some personal information, few questions, and they provide you with your credit report, and it's free. You can see all your payments, all your credit cards, all the loans that you have. If there's any inaccuracies, you can let them know and they will correct it. So again, it's a safe website that they operate together, and you should really take advantage of it because it's free.
Free is always good. Couple things I'd like to add here. Number one, when you pull your credit report from annualcreditreport.com, that will not show you your score. That's just going to actually show your credit history. What you're looking for there is information that is not correct. So for example, you may have an old medical debt that you paid off, but they said it went to collections when it didn't. If something like that happens and you find errors in your credit report, and unfortunately it's pretty common to find them, you want to dispute that item. To dispute that, you're going to go directly to the credit provider. So that would be either Equifax, Experian, or TransUnion. And when you pull your credit reports from the three agencies, they're not all going to have the exact same information. So for example, if you have a credit card and you're late on it 30 days, they just may report that to Experian, but not the other two. So if you have anything that is incorrect, dispute it. Disputing the burden of proof is typically on the credit card company or the debt company. So that works for you, because if you win, some easy ways to help raise your credit score. Last thing I want to throw out here too, while we're kind of on good tips, is make sure you use credit cards when you're making online purchases. Credit cards have more protection than just using your debit card with your bank. So if there's any sort of identity theft or anything like that, your credit card will provide more protection for you as a result. All right, you guys, here's just some good resources for you guys to use. Again, the first one we just talked about, that annualcreditreport.com. It is the only website that allows you to get access to your credit report for free. You can pull it once per year from each of the bureaus. The next one I would recommend looking at, this is something I personally use, would be creditkarma.com. This one does actually show your credit score. So if you want to see what your credit score looks like over time, if you have a credit card, oftentimes if you log onto their website, they'll provide that information for free. Otherwise, Credit Karma is a good way to do that. It's a free website to use. They'll also tell you what's good on your credit and some opportunities to improve your credit. The only downside of this website is from time to time, they will make recommendations on getting a new credit card or a loan or something like that. So as we talked about before, just don't run your credit unless you absolutely need it. Some other great websites is from the Federal Trade Commission talking more about how credit works. The Consumer Financial Protection Bureau has a great question and answer section. And this gets into great details on things from how does a credit card work, to disputes, to even filing for bankruptcy. And then finally, for some basic education, myfico.com has some great general credit strategies as well. Thank you so much, you guys, for listening. In just a moment here, we're going to transition to the question and answer portion. If you have not already done so, I would like to encourage you to sign up for the webinar again. At the same time next Tuesday, where we're going to be talking about connecting the dots to your financial future, part 2, talking about some great strategies on how to invest. If you'd like to reach out and learn more from us, please feel free to contact us at financialplanning@bfsg.com. If you have any personal questions you'd like us to answer for you, or again, if you'd like to request that free budgeting tool, that template that we have, we're happy to provide that as well. That email address again is financialplanning@bfsg.com. Thank you so much, you guys. And Chad, go ahead and take it away with our question and answer section.
Great, thank you for the great presentation, Arash and Paul. Again, before we start the Q&A portion, I'd like to thank anybody who does drop off and doesn't have any questions today or doesn't want to stay on for attending today. We hope you found the content timely and useful as you plan for the future. As I mentioned earlier, there's a QR code on the screen for those of you that use them. I also put a link to our survey in the chat box, as well as a link to next week at the same time, same place, a link to register for part 2 of Connecting the Dots to Your Financial Future. In case you have not registered for that, it is also available on the brochure and flyer that you already received. As we begin the Q&A portion, please do not hesitate to continue typing questions throughout this session. We will answer as many as possible before hitting the end of our 60-minute session today. So do not get your question answered before time runs out. We did have our contact information on the last page, financialplanning@bfsg.com. Please feel free to reach out at any point, and we're happy to answer questions for the foreseeable future. With that in mind, let me transition over to our Q&A portion today. We do have a number of questions. The first one was thinking about saving. What is a money market account?
A money market account is essentially a type of savings account. It doesn't, without getting too technical, it doesn't carry the same insurance as FDIC insurance, typically like a savings account does. But in exchange, you typically get the chance to get a higher interest rate. So that would be in short, what a money market account is.
Great, and so our next question comes, how come my credit score dropped by about 40 points when I paid off my house?
That's an excellent question. And again, that goes back to the factors that impact your credit score. If your credit dropped after you paid off your home, which you would think it would actually raise, right? Funny how that works. There's probably 2 causes for it. Number 1 could be the credit mix. So if all you have is credit cards and a home loan and you pay off that home loan, that impacts the credit mix. So that could potentially lower the score a little bit. My guess for the other factor there is the credit history length. If you paid off a mortgage, especially if it was a 30-year loan, that may be your longest running credit. So if that is paid off and no longer on your credit score, that's going to impact your credit history length.
Thanks, Paul. So next question is, what is your recommendation on consolidating credit card debt through one source to pay down at a lower interest rate?
Well, you can take it.
Okay, so this is a good idea if you're the right person in the right situation. Typically where we see something like this is someone that has maybe they can take a home equity line of credit to pay off some credit cards that were used for some unforeseen medical expenses. That'd be the most common way that that's done. Typically, the only reason to consolidate them is if you can get them paid off on a lower interest rate. Again, this would be a form of the Avalanche strategy here, where we're trying to lower the interest rates to make it easier to pay off the debt. Where this doesn't necessarily work is if you're using like a peer-to-peer lending, so like Lending Club or something like that. Oftentimes those interest rates are going to be the same, if not higher, than what you're paying on your credit cards. So that's not really going to be beneficial, especially if you're someone that spends a lot. If you just take a loan out and take all the money off your credit card balances, if you're going to be tempted to use your credit cards again, that could just get yourself in further trouble as well.
Yep. Thanks, Paul. Next question is, what is the maximum number of credit cards you'd recommend having to help raise your credit score?
2?
Yeah, I would say 2 or 3, by just making sure you pay your bills on time. That should take care of helping you with your credit score.
Yeah, you guys, as we talked about before, the credit utilization and your payment history are your 2 biggest factors. So having having two credit cards and just keeping them open and paying them off each month is going to be the best thing you can do.
And if I can just add too, if you have like a credit card through your bank, that's typically gonna have a higher credit limit. Whereas that Best Buy card that Paul mentioned, you're not gonna have a high credit limit on that. So that credit utilization, again, kind of comes into the factor. So if you've got a $10,000 credit limit and you're only using it for $1,000 each month, that's gonna help your score as well.
So next question, you mentioned getting annual fees waived. How do you do that? And do you call your bank and say that you can't afford them?
Say you can't afford them, say you don't want to pay them. And if you don't, you'll close the credit card. A lot of times they're willing to negotiate. Not all the time, but most credit card companies do. I think from my experience that I've heard from clients, American Express is the hardest one to negotiate with. But typically, most banks will waive that fee for you, especially if you have a long-standing history and you're making your payments on time.
That's right. I've actually done it a couple of times too. You can just call them, let them know you haven't used it in a while, you're planning to use it. And if you're talking nicely with them, they usually waive it off.
I mean, something to add to that is, I think where that really came from with Paul is if you paid off the balance, you're not carrying a balance on that credit card, you have to pay $100 or $200 annual fee to just keep it in your freezer, might not make a lot of sense. If you do have one of those cards with very robust perks and travel perks, and you are using it but paying it off every month and accumulating points and using the points and you get travel rewards, then maybe it's not that bad. Like I think the Chase Sapphire Preferred used to give you like $500 in travel rewards, and it's like a $500 annual fee. And so if you're actually leveraging the perks, then maybe that's not such a bad thing. I think it really comes down to if you're not using the card at all, it doesn't make sense to pay a couple $100s just to keep a credit card open. Next question is, we talked about how to get the free annual credit reports, but you specifically mentioned that credit report won't have your credit score. What is the easiest place for you to get your credit score?
The easiest place, or Arash, do you want to answer?
Well, I think you had a link in your sources, the myfico.com. That is also a place, and also on if you're with your bank, usually Chase, Wells Fargo, Bank of America, most of the banks nowadays have a section on their website that just shows your credit score, and also on their apps also as well, they have their credit score, or your credit cards also have that option as well. So if you look at it carefully, you should be able to find it.
Just log on to your credit card provider. Otherwise, use creditkarma.com. It's a free website. They'll give you estimates on your credit scores, totally free.
Yep. So next question we have is, if I only have one credit card with a high limit that I finally paid off, would it be better to keep it active and pay it off every month, or just keep it frozen?
I would say if you have a good credit card with especially a good rewards program like Chad talked about, use that credit card every month and pay it off every month. I know in my house, that's what we do. This maximizes our rewards. Ours is a cashback card. So, I quote unquote make money by spending money on the card. So why not? As long as if you're not disciplined enough to pay off the card each month, then maybe put it on ice. Otherwise, use it and just pay it off.
Remember, I can second that. So, I'm assuming it's the same for a lot of you out there, but I do the bulk of my shopping on Amazon.com. And so now I have the Chase Amazon Prime credit card that gives 5% back. So every single time I buy something, which is quite a bit on Amazon, I'm basically getting a 5% discount that eventually I'd buy something on Amazon with my points instead of using cash. I think the biggest piece of that is that if you're going to use the credit card, to make sure you pay it off every month. Otherwise, you start paying interest. And if you're paying 16% interest so that you can earn 5% cash back, you're still out 11% in interest. Right, so definitely, if you're going to use it, pay it off each month.
Exactly. And also, using credit cards makes this transaction safer. Nowadays, with a lot of fraud going on, if you buy things and there is some unusual activity, you can just call them and waive off the purchases on those credit cards, so it has that benefit as well.
So our next question is, again, on credit scores, is at what credit score would an increase, I'm assuming your limit, no longer matter, or maybe that's an increase in your credit score?
Okay, so just talking about credit scores in general, I don't know if this answers the question or not, but it does answer some good information to provide. The general rule of thumb is you want to have a credit score, just so you guys understand, it can range from 400 is kind of the floor to over 800. The sweet spot is you really want to be above 700. The closer to 720 or 750 is typically the threshold to get you that tier 1 credit, which is that best interest rate.
Perfect. And so the next question I'm going to pull in from the chat box, guys. So if you have a 30-day late payment posted on your credit history, how can it be erased or addressed? Especially if it was due to a login issue on the bank website during an extended vacation overseas.
That one I would definitely recommend disputing. I can't guarantee that you're going to win it, but if it's an error that's being caused by the company where you have issues to log in to their website and you weren't able to access it like you should have been able to, I would put the burden of proof on the company there, and certainly try and dispute that if that's the case or something like that.
And I'd just add, I mean, if you don't have a history of late payments, usually they're going to work with you to waive that. It's just, you just need to call and request it.
So our next one, I'm also pulling from the chat box that I saw in my Experian report when I pulled it that I worked for Allstate, but I never did. Should I worry about it and dispute it?
It would be a good idea to report it. Yes, definitely you want to look into why they would report something like that.
Yeah, I mean, along that same lines, I actually had another friend that had a similar situation with his employer, and it was actually a fraud situation where somebody else was using his identity. So definitely an identity theft issue. Somebody might have control of your social security number. Maybe somebody got a job using your information. Definitely something you want to look into anytime you see erroneous information on your credit report. So the next question all goes back to thinking about different types of investment accounts when you're saving. Which investment account should someone prioritize? An HSA, a Roth IRA, or their 457B plan, et cetera? For those of you that are, you have 401k plans, a 457B plan is just a similar option to a 401k plan for, government, and employees. Paul or Ash?
Well, it depends on your situation. If you do have an HSA account, HSA is a great savings account for you paying your health expenses because you get you have a double advantage there. You have tax savings also. The money grows tax-free, and when you take it out, you don't have to pay any taxes. So there's a lot of advantages to HSA account. And Paul talked about Roth IRA accounts. So you pay taxes up front, and in the future, the money grows tax-free. You can take it out tax-free after a certain age. So it definitely has advantages there, but they're used for different purposes.
Yeah, going back to the bucket approach that we talked about, you typically want to start with the emergency fund first, which is that savings account, a retirement account second. If you have like an employer sponsored plan and they're offering a match, I would typically start there and then look at other accounts from there.
Okay, so our next question is around credit length history. How is credit history length determined, and would it include a closed credit card or loan?
Credit length history is only for open accounts. So accounts that are closed doesn't really count towards that. It doesn't have the same impact.
Yeah, so to add to that, I think it goes back to the mortgage question we had at the very beginning, about how a very long mortgage payment that was all of a sudden paid off is no longer part of your active credit history, so no longer included. It's also, I think, why Paul and Arash suggested that if you have paid off a credit card and it has a decently high balance, it might not make sense, especially if it's one of your oldest credit cards, to close the account. Just throw it in a drawer somewhere in a safe somewhere just to keep that history behind you. Next question is, I'm looking to purchase my first home next year. What are some sources or items that I should really prioritize in thinking about this purchase?
Number one, congrats on home purchase. That's very exciting. Secondly, the thing that I would focus on are all the unexpected and hidden costs of buying a home. Buying a home will be one of the most exciting days of your life, hopefully. With that being said, you just got to make sure that you understand the additional costs that you're going to have with HOAs, with property taxes. We could do a whole nother presentation just on purchasing a home, but the place that I would start is just trying to make sure you have a really good understanding as to what are all the other costs outside of just the mortgage that go into owning a home.
I would just add too, I mean, what down payment are you going to make to that house? Is it 10% or 20%, and the fees associated if you put less down, and then getting pre-approved as well, and then just understanding what kind of house can you afford, going back to the budget.
Yeah, and thinking about that down payment, just to note that if you can't get to 20%, there is an additional mortgage insurance called PMI that you have to pay that could be anywhere from $100 to $200. And so when you think about your mortgage payment and what you can afford, being able to get to that 20% mark or even 25% and get that 75% loan to value definitely has an impact on the interest rate you're going to receive, which will all go into how much you can afford from an overall mortgage. I think right now with good credits, which hopefully lasts another 12 months, if you have really good credit and relatively low debt, I mean, you can get a mortgage right now at less than 3% for the first time ever in the US. Next question is, how does a home equity line of credit work? And is using money from this credit line, will it kind of bear you deeper in debt?
So, go ahead, Rush.
Well, if you have a home and you have a mortgage and your value of your house has gone up and the mortgage is much smaller than the value of the house, so you have built up equity in there, your banks usually offer you a line of credit, which means they give you an additional loan at a better interest rate than you would get for example, from your credit cards. So it's a much better interest rate. And if you need to borrow some money to, pay for things, that's an option. Also, if you have a lot of credit card debt, you can get a home line of credit from that and pay off your credit cards, which probably have around 20% in interest, and use this lower interest loan to pay those off and then pay off your credit line. So it'll help you that way. But if you don't need money, if you don't need it, applying for it might tempt you to spend more money. So it may not be a good idea in that regards.
And just know it, with the tax law changes, it used to be tax deductible if you paid it out and paid down those credit card balances. Well, that's still an option. It's not tax deductible anymore, that interest you pay. A home equity line of credit's only tax deductible if you take those funds and put them back into your house, refurbishing or whatever.
Our next question is, if I have a credit card from a clothing store with a low limit that I do not use, should I still keep it open? It is newer than my overall credit age as well.
I would tend to say probably no. If it's a smaller balance and it's a newer card, probably not going to hurt your credit score too much by doing that. It'll help remove some temptation on spending. And those cards can have annual fees as well, so it might save you some money there.
I agree with that. I actually done that a couple of times myself because I have a low credit, so it doesn't really impact your credit utilization. So it wouldn't be it would be okay to close those accounts.
Okay, so next question, it goes to the savings method. Paul discussed the 10-10-80. Talking about 10% for short-term savings, 10% for your long-term savings, and 80% for your expenses. What would be your recommendation for that middle bucket you discussed?
Excellent question here. Once we have that 3 to 6, so again, remember that short-term bucket is your emergency funds. We want to have about 3 to 6 months worth of living expenses for this bucket. So if you find that your monthly expenses are $2,000 a month, try and hit somewhere between $6,000 to $12,000. Once you've hit that threshold, that savings that you had going into this bucket, just have that instead go into the midterm bucket. And if you ever find that you need the short-term bucket, so let's say you're unemployed for 3 months and you use up all the short-term bucket, just switch it back and refill that bucket. But again, when anything above that 3 to 6 month mark, just move that savings into the midterm bucket.
So the next question goes into credit cards and perks. What are the best credit card perks to be looking for besides cashback? This could be a fun one.
Don't get Chad started on Amazon.
Yeah, I think this is kind of personal. I personally like cashbacks, but some people like traveling, so they would move towards that a little bit, or like Mike said Chad likes to buy things on Amazon, get that 5%. So that also helps out, but I think it's kind of personal preference.
Yeah, that Amazon works at Whole Foods too. But again, I think it really does depend on your own situation, right? So for me, who does do a lot of shopping at Whole Foods and Amazon, it makes sense to have that 5% cash back. My brother, on the other hand, loves to travel, and so that reference that Chase Sapphire Preferred has a really high annual fee, but he loves the travel perks that come with it, and he uses it every single year. So that makes a lot more sense for him. He also gets no transaction fees when he is traveling internationally. So it really does depend on your overall situation. A lot of people love the airline cards because they like to travel and they get perks, and you get the complimentary their elite rooms or whatever that might be at all different airports. Right, so it really does depend on your individual situation. Next question: is there any difference when you pull credit for a mortgage loan and checking credit for regular purchase like store credit cards?
Nope, an inquiry is an inquiry. So if you're applying for a new credit card, a student loan, or a mortgage, or whatever the case is, they're all going to show the same on your credit score.
So let me add some to that though, where there might be some differentiation. When you're applying for a mortgage, if you apply for a mortgage and you shop around and you shop at, say you're going to get rates from 2 or 3 different mortgage lenders, typically from a credit score perspective, that will count as one hard inquiry, because from a FICO score perspective, there's recognition that you're shopping your rate around. That would be different if you're applying for 3 different credit cards, because typically when you are approved for a credit card, you're getting the credit card. So 3 different credit card approvals are going to be 3 individual hard inquiries, or 3 different mortgage approvals, which I think it's within 30 days. Correct me if I'm wrong, Paul, Arash, or Mike. I think within 30 days, any mortgage pre-approvals you get all count as one hard inquiry.
Sorry, I'm not sure there.
Yeah, I'm not sure either.
I'm not sure of the exact dates, but you're right. I mean, on the soft and hard inquiries, soft is typically do not impact your credit scores. And like Chad was just saying, I mean, if you go to look for an auto loan and you just do a soft inquiry to understand what your financing is going to be on an auto. But if you actually go to apply for that loan or move forward, I mean, then there's going to be a hard inquiry.
Yeah, and just to kind of clarify, a soft inquiry is typically we're here pre-approval.
Yep, that's correct. I mean, things like when I bought my car, both the dealer and the financing company read my credit. And since the financing company counts as a bank, it actually did count as 2 hard inquiries. I was not very pleased about that.
Yeah.
Next question is for advice on student loans, especially since they tend to have lower interest rates. So it can be easy to allocate extra money elsewhere, such as home improvement that will gain equity in your house. Is that a good strategy?
No. One, you typically can get lower rates on home loans right now than you can on student loans. So I would definitely keep the 2 separate. We actually will be going into student loans in great detail 2 weeks from today. So I would recommend that you definitely join that call.
Yeah, I think the idea there that Paul's getting at is if you have equity in your home already, it would definitely make sense to get a home equity line of credit with a lower rate. With student loan interest rates, typically somewhere between 5 and 7%, if not higher if they're private student loans. So it probably varies based on the type of student loans and if you even have a home equity that you could take that home equity line of credit. If you don't have home equity line of credit, then it really depends on, again, your individual situation and how you're going to pay off the debt to build out your house a little bit to increase your equity.
And just going back, I mean, we typically recommend don't look use your primary home as an investment. That's where you're living, and by looking at it that way, I'm not going to pay down some debt to put money into it and get that equity. And I personally wouldn't look at it that way.
So next question is, do you recommend any refinance or consolidation plans for someone who keeps getting rejected for consolidation or refinancing for having student loan debt that's too high? Do we have any suggestions for that situation?
Okay, so kind of getting a little bit ahead of ourselves here with we'll talk more about this again in 2 weeks, but I would, number one, talk with the provider for the student loans, because you have different repayment options. There's income-based, there's the traditional plans. So there probably should be able to find some sort of repayment plan that you can afford. And I would start there.
Great. So hopefully that helped. Our next question is, I'm considering to establish an HELOC. Would this be considered a liability even though I never use it?
Well, I think having a home equity line of credit is useful to have in case you need emergency funds. You can pull that money in. It's a lower interest rate. So it is a liability if you're actually using it, but just having it open, I don't believe it is a liability.
No, it's the same as having a credit card open and not having to carry a balance.
Just note, if you haven't used it, the bank can always close it too. We saw that back in 2008-9. People thought that was a safety kind of bucket, one of those buckets they could draw on, and banks closed out those home equity lines of credits and they couldn't draw on them. So just FYI, I mean, you still have an emergency bucket. I wouldn't treat that as, it's nice to have, but I wouldn't rely solely on that.
So our next question goes against borrowing from your retirement account, be it 401k, 403b, 457b. Is it a good idea to borrow against one of these retirement accounts with your employer to purchase a home?
Well, whenever you borrow money from a retirement account, like a 401k, you do have to pay that back depending on your plan, you have to pay that back. So, I mean, depends on your situation, but.
Yeah, so I can add to that a little bit. I think it really does definitely depend on your situation, right? So if you take a loan from that plan and it's to purchase your primary residence, the length to pay back a loan to the retirement plan increases from 5 years to 15 years. The benefit is you pay the interest back to yourself instead of the interest back to the bank like you would on your mortgage. The catch to think about though is that home or that loan to your retirement plan, even though it's over 15 years, is going to be deducted directly from your paycheck. And if you were to ever leave employment, the entire loan becomes payable today. And so say you take this really large loan and you take out $40,000 to help you with a down payment, not only do you need to figure out how to pay back $40,000 over 15 years from your paycheck, which will be several $100s from each paycheck, and you still need to be able to afford your normal mortgage and regular expenses. Say you were to leave that job, 3 or 4 years later, you likely could not roll that loan over. Very few providers allow you to roll that loan over to the next retirement plan. And so all of a sudden, you don't have a $40,000 loan, less a couple $1,000s you paid off. Maybe you still have $35,000 outstanding after 3 or 4 years, and you have to come out of pocket to pay back $35,000, or it becomes a taxable event in that year, and you'll have a penalty tax. So definitely just something to keep in mind. If you're going to borrow, definitely make sure you're planning to stay employed for an extended period of time. Or that you have the resources elsewhere to pay back that loan if you were to leave employment. Also keeping in mind that while you have that out on a loan, while your home value might increase, it's no longer invested in the markets, which means you're also not getting any appreciation for your retirement plan. So definitely a lot of things to consider. Talk with your accountant if you're going to make one of these transactions as well. In that there's definitely some tax consequences depending on what bucket of money you're pulling up. Our next question. I just purchased a house in March of this year with 5% down and a 3.5% interest rate. Since rates are so low at historic levels, should I consider refinancing?
I think it wouldn't be a bad idea to reach out to some lenders to see their rates and their closing costs. If the closing cost isn't too much and it makes sense, you can compare them. There are easy softwares to use online to compare them. But for the most part, you should be better off if they don't have big closing costs.
And that depends how long you're going to stay in the house as well.
Yeah. So think that, between those closing costs, a lot of times, some lenders will waive them. Some lenders will roll that into your existing mortgage. Maybe you take out a little bit larger loan, but they roll the closing costs in. But say you're going to roll in, $2,000 to $4,000 of these costs. And if you're only going to save $200 per month with that refinance, and you're only planning to stay there for 1 or 2 years, then it might be break even or even worse. So if you're planning to stay in this home for 5, 10, even longer years, then yeah, it probably does make sense to save that 75 basis points in interest rate. But if you are only planning for the next 2 or 3 years, then maybe it doesn't make sense. So definitely weigh your options and think about how long you're planning to stay in your house.
And the mortgage lender can tell you all of that. They can do a break-even analysis.
Yep.
Next question, going back to our pre-tax versus Roth and saving in our buckets. Really quickly before we answer this question, we did just cross our 65th minute of a 60-minute webinar. I think most of us do have time to stay on, so since we do have a number of good questions outstanding, we are going to continue answering questions. But for anybody that does need a drop, being that you have a follow-up meeting that just started, thank you again for attending, and we hope you attend attend next week for our follow-up part 2 for connecting the dots. So back to our questions. For a retirement plan, is it better to do pre-tax or Roth?
The easy answer for most individuals is going to be a Roth. If you're younger, you want to take advantage of that tax-free growth versus taxable growth. With that being said, if you're an older individual, if you're closer to retirement and you're a high wage earner, where you're in a high tax bracket, at that point, you may want to look at the pre-tax option to defer taxes until retirement when you're in a lower tax bracket. But for most people on this call, I assume are probably younger. So I would assume most would probably want to use the Roth to get that tax-free growth.
Yeah, and so while the next question is being answered, I will post in the chat box a link. Mike Albee and I, who didn't get an introduction, but he has been answering a few of these questions here on the screen share. We did a webinar, I think, early last year in 2019, kind of talking about the difference between Roth and retirement plans. We're going to talk about Roth versus pre-tax, the pros and cons of each, as well as at the very end of it, talking about the difference between Roth and a retirement plan versus Roth and an IRA as well. So definitely a link that'll kind of dive a little bit deeper into this topic. It is, it could be an entire webinar just by itself. So this thing, I think it's between 10 and 15 minutes only, so pretty short and to the point. Would definitely be worthwhile research to check out. I'll put the link in just a moment in the chat box for all participants. So next account goes again back to the buckets that we have up on the screen right now, Paul. What is the best type of investment account for that middle bucket and non-employer retirement accounts? I think 2 questions there.
Yeah, no problem. So this middle bucket typically is going to be a taxable investment account. So that would be either an account in just your name, or if you're married, in a married joint account, or if you have a trust in the name of the trust. But this would want to be some sort of taxable investment account is what you would want to set up.
Perfect. And so our next question is a follow-up to the home equity line of credit. Is that used or is that reported to credit monitoring companies, and will it affect your credit score?
So both is reported. Whatever your credit limit is, that will be reported, and then if there's any usage month to month on the HELOC, that will be reported as well. And yes, that will impact your credit score depending on the total balance that you have on the credit compared to the amount that you use. Again, just looking at that credit utilization that we've talked so much about today.
Perfect. Thank you all. So that is the last question we have today. Again, we want to thank everybody for their attendance and participation today, interacting with us in the live polls and all the great questions we have. I think we're almost at 30 questions from the attendees today. Thank you for all your attendance. I did post, again, a link to that, our BFSG University on our website, which will have a link to the Roth and retirement plans for those of you that want some more information on Roth versus pre-tax. And then also in the chat box, I did put the link to our survey. Please let us know what you thought of our content today, as well as any topics that you might want to hear about in the future from us. And lastly, the last link I put is registration for part 2 next week, same time, same place, next Tuesday, the 22nd of September at 3:30 p.m. Thank you all for your attendance, and we hope you have a great evening.
Thank you.